Welcome back to another Zoom meeting. It is week number 7 in the summer semester of Money Study Group Online, Personal Finance at the University of Houston. And today we're going to talk about insurance. Insurance is an important part of every budget. It's expensive. And my goal is to help you become a better consumer of insurance. So today we're going to spend some time talking about property and casualty insurance. And we'll talk about homeowners insurance and some of the coverages that you need to know about and consider. We'll talk a little bit about insurance to value. How much insurance should you have on your house? We'll distinguish between a homeowner's policy and a renter's insurance policy. We'll talk a little bit about Section 2 liability and how that works. And we'll set the table for next week and the weeks to come and some of the stories that I didn't have time to share today to help you understand the coverages involved in both homeowners insurance and auto insurance. And then next week we'll jump into life insurance. We'll distinguish between term insurance, whole life insurance, and we'll also talk a little bit about disability insurance and long-term care insurance next week. So if you have questions or you're looking for more information that isn't covered in today's Zoom meeting, let me know and I'll be happy to do a short tutorial, anything related to insurance for the next 2 weeks. After that, we're jumping into investment strategies, and that's going to be fun. The most popular part of the course is always the investment strategies. So thanks for being with us. We've got a full 1 hour talk about insurance, property, and casualty. So we are recording now. It's, what is the date? July 7th already, and this is our University of Houston Personal Finance Online Zoom meeting, our weekly Zoom meeting. And the recorder is running. It's 10:04 a.m. I want to welcome everybody. This week, we're gonna start focusing on insurance. We're going to talk about property and casualty insurance today, and I'm going to introduce you to some concepts and tell you some stories to help you understand some of the most important, most common coverages in property and casualty insurance. Property and casualty means property, stuff like your house, your car, your motorcycle, your Winnebago, your fantastic toy, your diamond ring. Those are property insurance items. Casualty, thus property and casualty. The casualty part is liability. So if somebody gets injured as a result of your activities, that would be a casualty type of loss. So property and casualty today. Next week we will jump into life and health and long-term care. So lots of stuff to cover when it comes to insurance, and that's what we're going to focus on today. But before I jump into the insurance, I want to just kind of review quickly your Credit Crush assignment and tell you how that is going to layer on to this week's assignment. So last week in your Credit Crush assignment, you were asked to go ahead and find a dream house. And I know for many of you, there was some pretending going on, and that's fine. We're going to do that moving forward. We're going to pretend some things. So I wanted you to pretend you could afford the house that you really wanted to buy and identify it. And you did a great job. Most of you did a great job. You told me why you selected that house, and it was great. I didn't see any homes that were ridiculously overvalued or beyond what was potentially realistic for you, and so that was cool. And then you also were supposed to go buy that car that you always wanted, and again, the house and the car were supposed to be put into your financial plan. And the toy, that fantastic toy that I wanted you to go find and buy, I wanted you to do a little research, identify some price, some cost for each of those elements, your home, your car, your fantastic toy, and even, go on a spending spree and come up with a credit card bill that was pretty big. And the purpose of all that was for you to be able to go into your financial plan and start to do some debt payment analysis. So your financial planning portal gives you the ability to say, okay, I now have all of these debts built into my financial plan. What's the best strategy of attack to pay them off quickly? And so, yes, many of you have actual debts, loans, student loans, credit cards, whatever. And trust me, you'll be able to go back and use your financial planning portal to, make everything accurate and correct. That'll be pretty easy. But for the purpose of the rest of the semester and this course, I want you to push the envelope and dream big and play around so that you can demonstrate to yourself and to me that you know how to go in and use your financial planning portal to do some strategic design and some strategic steps. In other words, like for debt strategies, it's a very powerful tool that shows you if you pay it off, if you pay the minimum on these loans, here's how much you're going to pay over your lifetime. On the other hand, if you take a different strategy and you apply that different strategy to paying off these debts, wow, look at the difference it makes in your plan. And so you've done a great job overall showing me that you understand how easy it is to create different scenarios to demonstrate how those strategies are going to impact your plan over the long term. We're going to continue to add on to some of the what ifs in your financial plan. So right now you've got a house, you've got a car, you've got a toy, and you maybe have some imaginary credit card debt, and you can then start to do some strategic planning to see what happens if you take a different approach to paying those off. And what we're going to do in the next couple of weeks is we're going to add things like a retirement plan. So I'm going to give you $1 million and make you old like me. Your birthday is going to change from your current birthday to April 15th, 1962. That's not this week's assignment, but it's coming. So I want to plant the seed and tell you what's coming. And so you're going to have the opportunity to become old like me and fast forward the clock on your financial plan so that you can see what it really would look like if you did the things that I'm going to teach you to do in terms of investment strategies and retirement saving strategies. So some of that will just be unpacked as we go, but I just want you to feel confident knowing that your capstone assignment is being built along the way as we go. And most of you are doing a great job. Some of you, again, are missing the point, and I want to highlight that real quick and just say, for example, on the Credit Crush assignment, not very many of you, but some of you totally missed putting those things into your financial plan. Your new home, your new car, your fantastic toy, and if you like, a credit card bill that just demonstrates a big shopping spree. The point was to put those things into your financial plan and show me screenshots that you added them correctly, and then go play around a little bit to change the debt payoff strategies so that you can prove to yourself and to me that you understand that it does make a difference if you pay the minimum on these loans versus paying off the right one before the other one. And it's easy to do those strategies. So I've done some videos to demonstrate that, but most of you have a great grasp of that concept. So that was the point of the Credit Crush assignment. So enough about that. This week's focus is going to be on insurance. So one of the things I'm going to ask you to do is go ahead and add insurance to your home, to your cars, and we're going to talk a little bit next week about disability insurance and long-term care insurance and life insurance. So you're going to have a couple of assignments over the next 2 weeks where you're going to actually have to go in and put some insurance into your budget and into your life to protect the property that you now own. I know it's imaginary, but still, your plan now has these assets, the home, the car, or they may be liabilities because it may be purely on debt. Nonetheless, they have to be protected. So if you buy a home and it's 100% financed through the bank is going to require you to have homeowners insurance. And even if you don't own a home, if in reality you decide to rent instead of buy a house, which is not a bad option because there's a lot of expenses that go into owning a home. If you rent, say you rent a house or you rent an apartment, there is still something called a renter's policy that gives you very similar protection to a homeowner's policy. And that's what we're going to talk about today is the basic building blocks of a homeowner's policy. But like I said, even if you don't buy a house, if you rent, then you still want to have insurance to protect your property. So a renter's policy would cover something similar to what a homeowner's policy would cover. In fact, the coverages are identical with one exception. So I'm going to open chat and see. It looks like everybody's chiming in to tell me what time you got here. If you haven't done that, please go ahead and do that. And now you're welcome to start to answer some questions for me and just interact a little bit. But I just made the statement that a homeowner's insurance policy and a renter's insurance policy is identical with one exception. So think about that for a minute. A homeowner's insurance policy and a renter's policy is identical with one exception. What do you think that one exception is? It's not a trick question. It should be very obvious if you think about what's the purpose of a homeowner's insurance policy, and what would you want to have if you were renting a house and you didn't actually own the house? What would your exposure be? What would be your risk? Why would you buy insurance to protect that risk? So that's the question. What I said, homeowners insurance and renters insurance is identical with one exception. Renters insurance, question mark. Victoria, I'm not sure what you mean. Renters insurance for renting, like apartments and condos, that's right. But what's the distinction? I mean, it's for renters, clearly, instead of owners. But in terms of the coverage, the protection that you get, and the premium that you pay, what's the difference if the policies are identical with one exception? Returners protects your item, renters protects your items, that's right. But there's the other side of that, Victoria. Renter is for theft. Home insurance has fire and flood. So Daniel, that's not right. That's dangerously incorrect. And I'll tell you why in a minute. It's partly correct, but it's incorrect in a huge way that I want to make sure we cover, and I will. Only covers personal property, not the. So Angela, you nailed it. Homeowners insurance, the thing that's unique about that compared to a renter's policy is that the homeowner's insurance covers the house. So you were right about the fact that it covers fire. Renter's insurance is for theft. But here's the thing. So home and renters, they're identical, with the exception of, with a renter's policy, you don't have coverage for the house, for the property, for the building, because you don't own that. You don't have that exposure. If I own the house and I rent it to you and it gets blown down in a hurricane or burnt down in a fire, or if a big semi-truck or a dump truck runs into the house and destroys it, who has the loss? You're the renter. You're paying for renter's insurance because when that dump truck comes through the wall and destroys all of your furniture, you have coverage for your furniture, your computer, your stuff. But that wall and the brick, the wood and the insulation and the paint and the sheetrock and everything else that gets damaged, including the roofing members and the roof covering, all of that is part of the building. And as the person who owns the building, I have to buy insurance to protect my asset against that loss. So does that make sense? That's the distinction between home and renters, is the building protection. So you were partly right, dude, but one of the things you said is that renters covers theft and home covers fire and flood. So want to just clarify that. Do you think renters covers fire? What do you guys think? Do you think that a renter's policy would have coverage for fire? It's a very simple question. No. Ashley, you say no. Why? Nick, why would you say no? It covers items burned in the fire. Well, sure, that's what I meant. So that fire is a peril. That's a covered loss. Fire is the number one named peril in any fire insurance policy. And we're really talking about what used to be called fire insurance. So fire is the number one reason that property insurance even exists. So fire is definitely a covered peril. And if you look at a renter's policy, you're going to see there's a whole list of covered perils. And those same covered perils that you see in a renter's policy are going to be identical in the homeowner's policy. The only difference is in the homeowner's policy, those named perils only apply to the personal property. So a homeowner's policy has building coverage and it has personal property coverage. And renters has no building coverage, but it has personal property. So once you get to that part of the policy, they're identical. Let's see. So yeah, let's talk about flood water damage coverage. You had to use it, Morgan, you had to use it last year and it saved your life. So tell me so when you say flood/water, it's a very important distinction. It's a big difference between flood and water that comes out of a pipe inside of a house, whether it's your house that you own or the house that you rent. If water comes out of a pipe from a leak of a plumbing system, that's water damage, right? But that's very, very different than surface water, flood water that comes across the entire city of Houston when Hurricane Harvey hit and everything gets destroyed because of flood water. Two very, very different perils. One is a loss that results from a leak in a plumbing system. The other one is a natural disaster. So talk to me for a minute. Tell me what you're thinking about the difference. Yes, and sewage pipe burst in the ceiling of your room and flooded the apartment. So that is not flood. You say it's flood damage because an excessive amount of water came in and flooded your apartment. Okay, but keep in mind that insurance's terms matter in insurance. And when you say flood, typically flood is the number one thing. I'm going to introduce you to a whole new concept in insurance. It's called exclusions. So flood is the number one thing that's excluded when you talk about a homeowner's policy or a renter's policy or a business policy. Flood is the number one thing that's excluded. And here's why. Because flood is it's a huge peril, a big risk. And if an insurance company said, we're going to give you a relatively low-cost insurance product, it's going to cover fire and lightning, and it's going to cover theft and vandalism, explosion, and water leakage from plumbing and sewage systems. It's going to cover, I said fire, but it's also going to cover electrical, burning. There's a long list of things that are covered. Riot, civil commotion, lots of things that are perils. Some are covered, some are not. Flood would make the cost of those policies really high, because now you would have this peril that has a high, it's a very expensive peril, and it would make the cost of your homeowner's policy or your renter's policy very high. So they exclude it. So the apartment complex tried to classify it as flood, and they had to pay. So it was a big argument. Yeah, most big claims create coverage questions. And the insurance company tries to use the definitions and the cause of loss and so on to not pay the claim whenever possible. But anyway, that's an interesting scenario. What about people who live in Galveston? They don't pay for flood insurance, or is it something different? If you live in Galveston, Yolani, you better be paying for flood insurance. Most people don't know, and when I was a State Farm agent, I had one saying, it was like the only time I came close to being flat out rude to people, because I'd never ever wanted one of my clients to come back and say, hey, you never told me. You didn't make me understand. And this is what I wanted everybody to understand. You live in Houston. We live in a coastal area. There's water all around us. I don't care if your property never has been flooded. That's what people would tell me all the time. Hey, I'm buying a house. I want you to give me a quote, give me insurance on it. Okay, cool. I'll give you a quote. Here's your homeowners, but here's a flood quote as well to go alongside of it. And they would look at me and say, hey, the bank isn't going to require me to have flood insurance, because the bank won't require flood insurance if it's never flooded, at least back then. And so they would say, I don't need flood insurance. That house is never flooded. I'm like, hey, I don't care if it's never flooded. I'm going to tell you the truth. Listen to me. It's a no-brainer. You'd be an idiot not to buy flood insurance. And here's why. For one thing, it's not covered under your homeowner's policy. Number two is, we live in an area where every square acre of land is being developed, which means they're putting concrete, asphalt. The water's not going to have anywhere to go. We live in a coastal area where we get a lot of heavy rain fast. It's inevitable. It's going to happen at some point if you live in that house for very long. And here's the real reason. This is the reason it's an absolute no-brainer, because flood insurance is subsidized. What does that mean, subsidized? It means somebody's paying the bulk of the cost, and as a consumer, you're getting it at a huge discount, because flood insurance is underwritten not by an insurance company. No insurance company has the resources to pay for the cost of the claims that come from widespread flooding. No insurance company could do that and stay in business. So who does that? The federal government underwrites flood. It's a massive, costly thing, flood insurance, and you get to buy it at a discount, especially if your house has never flooded. Then you get to buy it at what's called a preferred rate. So for that reason, as a financial advisor and as a State Farm agent, I was always very clear with folks that when you buy this house, even if it's never flooded, it's a no-brainer. Get flood insurance. And people would sometimes get mad at me, and I'd be like, I'd rather you be mad at me now and remember that you were mad at me because I tried to get you to buy flood insurance, than be mad at me because I didn't tell you, and then you lost $250,000 because you didn't have flood insurance. And when that happens, I'm going to remind you how you got mad at me today when I said it's a no-brainer. So most of the folks who did business with me ultimately bought the stupid little flood policy, and it turned out not to be stupid. Now, in Hurricane Harvey, I don't know if you guys know this, but I've been an adjuster for many years. Before I became a State Farm agent, I was a claims adjuster, a fire claims adjuster, not an auto claims adjuster, because I was smart enough to know when I did my little career research into the world of insurance, I knew that auto insurance adjusters got like 300 claims a month. They were just buried at their desk with these claim files. And I was licensed to do auto claims, but I had no desire to be sitting there with 300 new claims every month. As a fire claims adjuster, they got a very small number of claims because I was a field adjuster. I don't know about you, but I like variety in my life. And so as a claims adjuster, I wanted to be able to get in my little company car, drive around all over. In fact, I handled Galveston, Crystal Beach, everything from here to the water was my territory when I was with State Farm as a claims adjuster. And I got to go see some very cool things, some very weird things, both on the property insurance side and way more interesting on the casualty side. And I'll tell you some stories about some of those claims that I handled to help you understand what's covered. And remember, my number one priority in this week and next week when it comes to insurance is I want you to become a well-informed consumer, because you're going to spend a lot of money on insurance in your lifetime. So I want you to understand the most common coverages and which coverages you need to buy and how you need to set up your policies for the most common things that are going to give you exposure. So flood insurance is a no-brainer if you live in this area and you own a house. Now, that's not so true if you're renting an apartment and you're on the third floor. Then I'm not saying that's a no-brainer, but I'm saying if you have a house, even if it's never flooded, you want to buy flood insurance. So unless you're on a house on a really big hill, but I don't know of very many big hills around here. So that's all right. What about properties in floodplains or 100 flood areas? Morgan, I think you're talking about properties that are in areas that didn't flood for the last 100 years or whatever. And I would say if you're in this area, in a coastal area, buy flood insurance, especially if it's a house that's never flooded, because you're going to get it cheap. I've only had one flood claim, but it paid for the policy for 10 years. But my story's not the reason. Trust me, it's a good investment in terms of the dollars that it costs and the coverage that you get. So question, flood insurance is completely different, right? Yeah, flood insurance covers one peril. Flood insurance doesn't cover fire, doesn't cover wind. Think about that. Flood insurance doesn't cover wind. So if you guys bought your dream homes, and some beautiful homes they are, I hope you have me over for barbecue or a garden party one day in those beautiful houses that you picked. You guys have great taste in houses. But let's just imagine that a hurricane hits. Now, some hurricanes are dry. Some hurricanes are ferocious windstorms. Like, for example, you may not remember 1993, but I worked Hurricane Andrew. And I was assigned to Homestead, Florida. Just Google Hurricane Andrew, Homestead. Google that. See what image you see. Hurricane Andrew, Homestead, Florida. It looked like the city was like a nuclear bomb fell on the city, because Hurricane Andrew it was a Cat 5. I think it was categorized as a Cat 4, but it was really a Cat 5. And they found out later that a whole lot of people lost their lives, which is one of the things that changes which category it is. But as I recall, it was 150 mile an hour winds. I'm not positive I recall, but I'm telling you, it looked like a war zone, Homestead, Florida. And so that storm really didn't have any flood. No flood. There was no water, so it was just pounding wind. And so when I worked Hurricane Andrew, I lived in Key Largo, very beautiful place. I don't love Florida because I've spent way too much time there working hurricanes. But in Florida, they have the Everglades, which are cool, just a bunch of trees and swamp. And so if you drive through the Keys, Key Largo is like the first of the Keys. They're like little islands connected. But you drive through the Keys and the trees were all snapped off in Hurricane Andrew. But if you go north to Homestead, that's the southernmost part of Florida, a little city, Homestead, got wiped out. And so Miami got a lot of damage too, but there was no flood. So do you think the homeowner's policy covered that? Is that part of what you would get protection for in a homeowner's policy? And if that's true in Florida, what about Texas? Do you think wind and hurricane is covered? Is it a covered peril? So that's a big question. I see no, not the wind. No, no. Tell me why you guys are saying no. Because even a tornado could cause wind damage without any flooding. Well, that's true, but so Azan, would a tornado be covered? That's windstorm. Would a tornado be covered in your homeowner's policy or your renter's policy? What do you think? So here's the answer. Yes, so homeowners maybe. Typically, yes. Typically, tornado, windstorm, hurricane is covered. But in the coastal areas, they've started to have this exclusion because it's an expensive peril. Just like flood, if you live in a hurricane zone like we do in Houston, there's a big exposure, a big expense for that one peril. So what they do is they've started to give the option to exclude the windstorm, hurricane, and hail. Those are perils that are all part of the same kind of combination of weather metrics. So they've given that option to exclude it, in which case then you have to buy windstorm insurance. So not only do you have to go buy flood insurance, but now you have to buy windstorm insurance in areas like Galveston. Some companies will provide the windstorm with the policy. I happen to have an insurance company that provides the windstorm coverage, so I don't have to have it. But you have to look, you have to check. People love to get low-cost insurance. And what I want you to do is make sure that you understand that you want to make sure that you have the right coverage, because if you buy cheap insurance, but you don't have flood insurance and you don't have wind insurance, yeah, you got cheap insurance, but you didn't get what you needed. And so with a homeowner's policy, you want to make sure if you own that dream house that you're covered for flood and you're covered for wind. There's one other thing I want to cover in homeowners insurance on the home, and that is probably the number one, and this is true across the country. So when I talk about coastal areas like Texas, Houston, not everybody lives in a coastal area. So flood and windstorm and hurricane hail, those are not as big of a risk in some places. Like California, it's earthquake. So if we lived in LA, I'd be talking about earthquake coverage, which again is excluded. Obviously, your homeowner's insurance in California is not going to cover earthquake. Another common peril that's not covered, we live in a place where the soil is always swelling and shrinking, and that makes foundations break and earth movement, and your house, you see cracks in your sheetrock and in your brick. If it's a 20, 30-year-old house, you see that. If you go in a neighborhood where the house is older, that's not covered. Typically, you have to, that's just too big of a risk. So you want to know what's covered. Another thing, this is one thing that is the most common thing you want to know when you buy a homeowner's insurance policy, and that is, do you have replacement cost coverage? Replacement cost coverage is a really key feature of a homeowner's policy. So let me give you an example. So today we're here in Houston, Texas, and let's say that my house, I paid $162,000 for my house in Friendswood back in July of 2000. Today, if I sold my house, I could probably sell it for $250,000. And so how much do you think I should insure my house for? How much coverage should I have on my house? Sorry, I've got a pop-up Oh, I hope I'm still there. Yes, I'm still there. So how much coverage would you have on a house that you could sell for $250,000? And does the market value of the house even matter in terms of the insurance? How much insurance should you have on your house? That's the question. So some of you bought a house this last week, you found your dream house, you went out and purchased it. So how much insurance should you have on that house? Say the value, not what you paid for. So Nick, tell me more about that. The value. What do you mean the value? Be more specific. So you should insure your house for the value, not what you paid for it. So in other words, if you were able to get a super good deal on a house, like if I could buy my house for $100,000 because maybe my dad sold it to me, but I could sell it for $250, I shouldn't insure it for the 100 that I paid for it. I should insure it for the value, the market value. That's what I think I hear you saying, Nick. But you're not really replying. So I'm assuming you're still with us, Nick? Yes, that's what I meant. Good. It's okay. No need to be sorry. I just need a little interaction here. So only one interacting student at the moment makes me feel a little lonely. Oh, I see a bunch of people are waiting to be admitted. Sorry about the ones who just got admitted. I missed that cue. So here's what you need to think about. It's not even the market value of the house. So you could buy my house, say I could sell it for $250,000. I could sell it to you for $100,000 because you're my buddy. But that doesn't have any relationship to what you should insure that house for. So what should you insure that house for? Here's the answer. You'd say at least $300,000, Randy. That's a good call, but why? What if my house in Friendswood is on a half-acre lot, which mine is actually on a 3/4 acre lot? And let's say that in Friendswood, that lot is worth $500,000. It's not, but let's just pretend it is. And I have a house that's, well, let's use my house instead of, so I've got a house that would sell for $250,000, but the lot is worth $100,000. So if you bought my house in Alvin, just 20 miles south of where I live, you probably could get that house instead of $250,000. You could probably buy my house for $170,000 because they'll give you the lot. I mean, it's the property in Friendswood that's pretty valuable. So should I insure my house and include the property value? Because is my insurance policy ever going to pay for the land that my house sits on? In what scenario would my insurance policy pay for the land? Think about that. Just think about that. What is it you're insuring in your homeowner's policy? So Randy, $300,000 for a house that sells for $250,000 in Friendswood with a lot that's $100,000. Does that still seem like the right answer? I'd say no, because you could build my house in Friendswood for the same exact amount you could build it in Alvin. But people like Friendswood Independent School District, and it's kind of a better neighborhood, more planned. It's just, better police, better fire. Don't ask me why. People pay more to live in Friendswood than Alvin, but it's true. So do you need to insure my house for the full $250,000 because that's the market value? That's not the right answer. Here's how you should think about it. So my house is a 2,400 square foot, 1-story hip roof, and it's built with better than builder's grade stuff. So builders can build a house cheap, right? They can put all the cheapest material possible so they keep the price down so they can sell more houses. But over time, you probably want to redo the kitchen and the bathrooms and put wood floor down and, fancy it up. My house was actually built fancied up, and then we've fancied it up even more over the years. So that's what you want to know, is what kind of quality material is in the building. Because if it got destroyed, if it got bulldozed and you had to build it from the ground up, how much would it cost? to rebuild the house. That's how much you want to insure it for. And the problem is, you can say that my house, to rebuild it, how do you measure all the items that you put in it? So that's a great question. There's these things called replacement cost calculators, and they take a square foot and they apply a formula. And just say 3 different formulas. We've got base, that's go to Home Depot, find the cheapest everything you can find, right? Like the cheapest. I put 2 ceiling fans in my house this weekend. I was pooped when I got done. One of them is a big vault ceiling, and it had a long rod in it. But I got a nice ceiling fan. In the kitchen, though, I put the cheapest ceiling fan I could find. My wife, it was a little teeny thing. But think about that. You go shopping at Home Depot or Lowe's, you can get the cheap, the middle grade, or the most expensive, right? And that's how they calculate the replacement cost of a house. They have a formula, and it says we're going to use everything cheap, cheapest paint, cheapest material, cheapest electronics, cheapest carpet, blah, blah, blah. Or we're going to do the middle grade, and we'll use that formula. Now, my house is 2,450 square feet. So you multiply that by which of those formulas, and you come out with a number, and it says you should have, for that house, you should have $200,000 of insurance. Okay? So if you had to rebuild my house with a new foundation, with everything, $200,000 to rebuild. Doesn't matter if I build it in Friendswood or Alvin or Port Lavaca. Doesn't matter. Same house. Now, it would matter if I built it on Crystal Beach and you had to take the ferry to get there because it's further away, so the labor costs might be higher. There are other things that affect that value. But basically, you pick an area, you say in this area we have 3 formulas, and you multiply the square footage of the house to determine the total replacement cost of the house. That's what you do. And so that's how you figure it out. But the problem is you can insure your house for less than what it should be insured for, in which case you get penalized. And here's how that works. If you have less than 80% insurance to value, you don't get replacement cost coverage. Replacement cost coverage means if you have a kitchen fire, and let's say my house is 25 years old, my kitchen burns, contractor comes in, he wants to replace it, my kitchen is going to cost $50,000. That's the replacement cost. But the insurance company comes in, the fire claims adjuster, the job I used to have, and I write an estimate as the adjuster, and I go, oh, yep, it should cost $50,000 to replace your kitchen because it's this big, it has this quality of material. But here's the problem. You're only insuring your house for 75% of what it should be. So 75% of 200,000 would be 150,000. That's what I'm insuring it for. That's less than 80%, which would be, if I had 80%, that'd be 160,000. And in Texas, if I have 80%, that's the magic number, then I get full replacement cost. But under that, I get actual cash value. Bummer. So many people take that cheap insurance and they don't know that they don't have replacement cost coverage. So then the adjuster writes that estimate and says, yep, 50 grand, that's what it should cost. But we're going to deduct, since your house is 25 years old, we're going to deduct 50%, and we're only going to pay you $25,000 minus your deductible. Surprise. So that's a big ticket item on a property insurance policy, is replacement cost. You want to make sure you have replacement cost coverage, which means you need to have at least 80% insurance to value. And your insurance agent should help you with that. But these days, a lot of folks like to go shopping online and just, create your own policy like Build-A-Bear, and it's not always a good idea if you don't know what you're doing. So replacement cost coverage. So that's that. I want to move on into the liability section. Man, this is what happens every semester. We have so much to cover, we run out of time. Somebody have a question? I see. If you have a question, put it in and I'll try and answer it, but I'm going to jump into a couple of specific coverages. So we've talked about property insurance on a home. I want to talk about section 2 of a homeowner's policy. It's the liability section. Remember I said this is property and casualty. We're talking about property and casualty. So we have coverage for the property. We've spent a good deal of time talking about different ways that you get coverage for the property. Including making sure you have coverage for things that are excluded, flood and wind sometimes if you live in a coastal area, earthquake if you live in California. Replacement cost coverage, that has nothing to do with exclusions, but it does have to do with a requirement that you keep 80% insurance to value. Those are all part of the property insurance idea. But on liability is damage to property or injury to people as a result of your activities. So you have coverage on your homeowner's policy. And remember, the homeowners and the renter's policy are identical with one exception, and that is the home. On a renter's policy, you don't have to worry about insuring the building. But on a renter's policy and a homeowner's policy, you have section 2, which is liability. Liability is what happens when you do something or someone gets hurt on your property and it turns out that it's your fault. So they call it the reasonable man principle. So reasonable meaning if I own the property, I have to maintain it in a reasonably well way so that if you come over to my house or you're just passing by, you don't even have to be invited. But if you're on my property and you get injured because I had this big hole, maybe I dug up my sidewalk and I was trying to fix a leak in my sewer and I left it open and I went and said it's Miller time, I'm going to leave it, and you're walking your dog and it's nighttime and you don't see the hole and you fall in the hole and you break your leg, that would be my fault. It would be my failure to act as a reasonable man in maintaining my property that would provide you with a liability claim against me. So that's just one little example of why my insurance policy for my home, which protects me and everybody named in my policy who lives with me, who's a named insured, they're all protected so that if I get sued, my insurance policy will respond and it will defend me. So a couple of things you should know about liability. Section 2 of your homeowner's policy, in that it does protect you against liability, only if it's your fault. If it's not your fault, the policy still protects you for defense cost. Now, I don't know about you, but if you've ever been sued, you know that the cost of defending yourself in a lawsuit can be very, very high, very expensive. And so one of the benefits of your homeowner's insurance, or again, your renter's insurance, is that you get liability protection. In Section 2, they pay to defend you against the lawsuit. So if it's not your fault, you still get sued, they're going to defend you. And that cost, that coverage is unlimited. Think about that for a minute. Now, let's say in the scenario I just gave you that you fell in my hole that I left open, and so you sue me. My insurance company will defend me, but they're going to do an investigation and they're going to identify the fact that, yeah, I left a big hole in my yard, you got hurt, and it is my fault. I'm 100% negligent, in which case, when you make your claim against me in court, I'm going to lose. So what's the insurance company going to do? They're going to pay that claim, and they're going to close that claim, and their duty to defend me in court goes away once they pay the claim. And maybe they pay the claim, and so let's use a different scenario. Let's say that hole was really, really deep, and you fall in that hole and you die. And so your spouse sues me and I lose, but I get sued for $1 million instead of 200,000. Or let's say my policy only has $100,000 liability protection, which, by the way, in Texas, that's the base amount of liability. If you buy a package renter's policy or homeowner's policy, your liability protection is $100,000. Not much. So you fall in that hole and you die and you sue me. My insurance company pays the $100,000, the policy limit, and they're done. But you sue me for $1 million. What happens then? Well, does the insurance company have to defend me in court, against that $1 million lawsuit? No, their duty is to defend me until they make a determination, and then they pay the claim. And once they close the claim, their duty to defend me is done. So that brings up another coverage on the liability side, and it's called a personal liability umbrella policy. And a personal liability umbrella policy protects you for typically $1 million over and above your home and your auto. And that's where it would come into play, is in a claim against you that goes way above and beyond the coverage that you have on your underlying property and casualty insurance, home or auto. So your auto insurance has the same kind of structure as your homeowner's policy, and you're going to pay a lot of money for car insurance. So let me just take a breath here and talk for a minute. We're getting close to being out of time, so I'm not going to get into auto insurance in this lesson. I'll create another. I'll do some tutorials to cover some auto concepts because they're very important, and I could tell lots of stories about insurance, and I want to tell you some stories about homeowners and auto, but we're running out of time. So let me just summarize and say, the purpose of insurance, it's really risk management. Managing risk in your life is very important. I don't know how you get around, but today I drove my motorcycle. So because I drive a motorcycle, I have more risk, because driving a motorcycle is a little bit more risky than driving a F-150 pickup truck. So for me to manage risk, I have to do some things a little differently, and so do you. Managing risk is part of life, and one of the ways we manage risk is to just avoid the exposure, avoid the risk. So for me, I could sell my motorcycle and not drive a motorcycle. That's one way to avoid it. Another way is to reduce the risk. And so for me on a motorcycle, I live in Friendswood. I work here on campus. And so I'm able to take the express lane, which it's free on a motorcycle. I get on down south, I stay on the express lane all the way to U of H exit, and then I get off. And so I don't have to deal with traffic on both sides of me. It's one way that I reduce the risk of driving a motorcycle. So just think about some ways you can reduce risk. Because if I get killed on a motorcycle, I should have a lot of life insurance, and there's a lot of things that could happen in my life with the people I love that I need to protect. And I could avoid that risk, or I could reduce that risk, or I could transfer that risk. So for life insurance, I could buy some more life insurance because I drive a motorcycle. Same with a Winnebago or a boat. If you have a boat, if one of your fantastic toys was to get a boat, boats have a lot of exposure for liability. So whatever you do in your life, there's some risk involved. And one of the things you can do is you could avoid that risk, or you could work to minimize it, or with insurance, you can transfer risk. And that's the whole purpose of insurance. And it's the number one way that we manage risk, is to buy insurance. And that's why insurance becomes one of the biggest components of your budget. And my goal for you is to learn to be a wise consumer of insurance, because if you know what you're doing, you can maximize the coverages that you have while minimizing your cost. It's one of the reasons why I say if you're going to own a home in a coastal area, you definitely want to have flood insurance. You can raise the deductible on your homeowner's insurance, which will lower your premium. Deductibles are one of the ways you can manage the risk and the cost of your insurance. The higher your deductible, the lower your premium. So this week, what I want you to do, and you'll see this in your assignment, is you're going to go buy insurance for your home and your car, and you're going to pick a deductible. That deductible is what you keep. It's the amount of risk that you retain, because if you have a loss, you pay the deductible, whether it's your home or your auto. So you're going to go get insurance on that fancy house you bought and that awesome car that you bought and maybe even that toy. You're going to go add insurance in your financial planning portal to those things that you bought. And you're going to get a sense of how that protects you, but also the cost. So that's going to be your homework assignment. And next week, we're going to jump into life insurance. There's lots of different types of life insurance, and I want to make sure you understand the difference between term life insurance and permanent life insurance. So we'll go over that next week. Talk a little bit about long-term care insurance and disability insurance. And we'll talk a little bit about health insurance. But here's what I want you to do when it comes to insurance. I want you to be thinking about, what are your questions? What is it you want me to answer for you? And I'll do that either in a short video or I'll try to address them next week in our Zoom call. But there is so much that we could talk about under the umbrella of insurance. And unfortunately, or fortunately, if there's one area that I'm an expert in, it's insurance. I've got a lot of letters after my name, and I've been in the business a long time. And it's easy to kind of get lost in the weeds, but what I want to try to do is help you understand what are the most important coverages that you're going to have, and how can you configure your policies in such a way that you get the best bang for your buck. So stay tuned. I'm going to try to tell all of those stories and make sure you have access to them. You won't need them to get an A in the class, but you will need to know all of those stories to get the best bang for your buck when you're buying insurance as a consumer. So thanks for being here today. This will be posted in our YouTube channel. And if you have questions, you know how to reach me. And I look forward to grading your assignments next week. Keep up the good work. And thanks for being here. We'll see you. Take care.